I thought I'd take this opportunity to review a little bit more what was talked about yesterday in the free blog, which you can find on my website. I also do it on Substack at Navigating the Markets, and I provide a link of that in the community section, so please remember to subscribe to this channel so you get all those updates. But basically, we're at an inflection point here in the market, and I mentioned yesterday in the member area that this feels a lot like the July of 2024, and we kind of talked about this over the weekend regarding volatility dispersion, but I just wanted to try to explain it a little bit more again, because I think this is a really important concept that we're gonna kind of have to talk about a little bit more as we go through the summer, because we're just at that point where volatility is kind of being pushed to the max. And what you're seeing really taking place here is sort of the limits of that. And if you notice today, for example, the VIX is up about 4%, which is not a big deal, 56 basis points to 1720. And the VVIX is also up on the day. And one of the reasons why that may be happening is because when we look at where realized volatility is, you can see that that's actually rising today just a little bit to 5.2% from 5.01% yesterday. And essentially, the realized vol is at this level where, if you start moving, if you take the realized volatility number of 5.3%, if you take the realized vol of 5.3% and divide it by 16, which annualizes it, what it's implying is that the S&P really can't move more than 33 basis points up or down without pushing up realized volatility. And really, you have to go off of yesterday's number, which was 5.01. If you take 5.01 and divide it by 16, that's only 31 basis points. So the S&P really can't move more than 30 basis points today, up or down, because remember, realized volatility works in both directions. You really can't see the S&P 500 move more than 30 basis points up or down without pushing up realized vol. Now, the interesting thing as we're doing this is that we happen to be down exactly 31 basis points as of this moment, and you can see that we're getting realized vol just ticking up just a little bit. And the more that the market moves more than 31 basis points, again, up or down, the more that realized volatility is going to rise, at least on the 10-day kind. On the 21-day kind, to really start seeing realized volatility rise, you have to start to see the S&P really move more than 50 basis points. So let's say, for example, today the S&P finishes down 30 basis points. It would probably mean that, realized vol for the 10-day kind would probably creep up just a little bit, and 21-day realized vol, which is a 1-month measure, would probably still fall a little bit. Meanwhile, the 3-month vol, which is the blue line, is way up at 13, so that still implies you need a decent-sized sell-off to really get 3-month realized vol moving up. But what this is implying is that volatility is really compressed at this point, and that the trading range of the market is very limited. And so what happens is that as the market begins to anticipate the idea that realized vol is going to start moving up, you begin to actually start seeing the VIX move up in front of it. And you can really see that quite well when you just lay the VIX on top of the 10-day realized vol. And it tends to always, lead a movement in realized vol, and it tends to also lead it on the way down. So what this is kind of implying is that the market volatility is beginning to anticipate a potential move higher in realized volatility in the S&P. And essentially, the way I think about it is that people are probably starting to take out hedges, right, to protect to the downside. And when you start protecting to the downside and implied volatility starts creeping up, that puts downward pressure on the S&P. And if you look at the chart and you go back, to August and July of 2020, if you go back to July of 2023 and you go back to July of 2024, realized vol bottomed on basically July 26th. and on July 9th or so. And if you notice, they also bottomed around, in this case, 6.5, in this case, 4.5. And like I said, we bottomed at about 5% yesterday. And if you go back to December, we were as low as 4.4, and then we were as low as 8.5 on February 18th. February 18th, obviously, ahead of earnings season. This was also around the time of the earnings season, and this was also around time of earnings season. So we have those characteristics that are very similar in the marketplace right now from a volatility, a realized volatility standpoint. It's probably also telling us that implied volatility has roughly bottomed around 16. When we look at implied correlations, we bottomed also in July of 23, July of 24, and here we are. We already kind of bottomed, it looks like, in July 10th, right around the same time that this bottomed. And this kind of also implies that implied correlations are fairly low. And what that implies is that we're probably at a point where the market could suffer some sort of pullback here. And I know that's not something that people think could actually happen because all the market does is go up. But the reality is that with volatility this low and implied correlations kind of where they are, it means that the repeat of the summer of 23 and 24 is a very good possibility. And right now, I mean, again, that's why I say it has this feel of what was 2023 and 2024. I mean, on top of that, I mean, when you just look at the technicals of the marketplace, obviously the S&P isn't as overbought as it was, but it was very overbought at one point. The NASDAQ yesterday got overbought again, got an RSI up to 73, just about touched the upper Bollinger Band, missed it by a little bit. But you can certainly see when you start looking at some of the components, NVIDIA obviously extremely overbought with an RSI near 80, got above the upper Bollinger Band. It's largely responsible for most of the move we're seeing in the market today. Pieces of the market, Meta, for example, really hasn't been acting well more recently. I had noted in a write-up, and I had noted it for members, that when you look at where Meta is, it has what looks like a 2B top, meaning that you made a new high here. It was just slightly higher than this previous high. You didn't really hold it. You came back down. You broke an uptrend. Now you're testing the support level at 704. Can't get above, the 20-day moving average. That's usually a sign itself. And here you are also below the 10-day exponential moving average. Tried to get above it yesterday, failed. Tried to get above it again today, failed. RSI clearly rolling over. So this is one of your market leaders, NVIDIA, Meta rolling over. Obviously, you have Tesla reporting results later today, also been, consolidating. So when you just look at where we are, you have the elements for a potential pullback here. And I mean, generally speaking, when you just look at, how the S&P is sort of configured here, I mean, you could, if you draw a trend line from the bottom and you start trying to just manipulate it a little bit, you can start getting a sense of where we are in this cycle overall. I mean, there's your potential for a rising wedge. Again, we've had other ones that have looked similar to that in the past that haven't worked, or where they worked and we consolidated sideways. Plus, from what I've heard, there's a couple of other sort of technical indications that suggest, a pullback is likely. So that's really all I had. I just wanted to touch base and kind of just go through the mechanical aspect of it a little bit. I'm sure that's not something most people talk about, but I think it's important. It's an important concept to try to understand. And obviously, I talk about this more in the membership areas. But please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you later. Bye.